Hi everyone, my name is Ruca, and I'm a head of institutional for Karpatkey, and I came here to talk about the different ways institutional investment firms have been accessing the digital assets market, and also some ideas around bridging some of those assets into DeFi, hopefully. Let me first talk a little bit about what we do at Karpatkey. So Karpatkey is a DeFi native organization specializing in professional DAO finance, and the leading asset manager on-chain. So we've been dominating the active DAO treasury management by managing 1.7 billion plus in assets for the leading DeFi protocols out there. We've been doing so without any loss of or hacked funds. We've also been contributing directly to the protocol development through established delegate platforms and through industry-leading research, which basically provides us a lot of alpha and gives us a lot of ideas in how to sort of deploy our assets. So we've been operating in the core of DeFi, right? DAOs. It's super chaotic and super dense environment. But in between, what happened on the institutional side? So essentially, they've been accessing the digital asset space in 4 different ways. First and foremost, through direct LPing in venture capital firms. Second one is by establishing or deploying funds into liquid funds through mostly hedge funds or whatever, deploying quantitative strategies and market neutral strategies. Then the third way was through direct exposure, so directly acquiring Bitcoin and other assets or other correlated assets and having access to mutual funds and most recently to the Bitcoin ETFs. And then tokenization, the buzzword du jour, which just basically means acquiring ownership rights directly through tokens deployed on blockchains. So let's look at each one of these categories and how they perform throughout the years. So the first way institutions got access to digital assets market was through venture funds. And the reason for that is because they could shield themselves from volatility by deploying the funds directly into institutional quality ones and being able or avoiding having to market on a monthly basis. Unfortunately, this environment has been deeply affected by macro conditions and wars and whatnot, and in the increasing sort of Fed rates also made that a bunch of these guys have been rotating the funds back to more secure and stable forms of investments such as bonds and whatever. They're also been obviously exposed to the bad news and the terrorists and the FTC's blowouts and whatnot. And then these guys also started taking advantage of the inefficiency of the market. So all of those sort of volume and market neutral sort of strategies started to take place, and it's curious to see how hedge fund strategies not necessarily netted from expenses, not necessarily overperformed direct exposure to BTC. They decreased the volatility, but they haven't overperformed. On the direct exposure side, we've seen record investments, and also recently surpassed the 60 billion mark in investments in BTC and all other correlated sort of assets. So there's been a massive expansion of the market, mostly through the launch of the US ETFs, but also the increased sentiment, and we can see these through the increase in volumes on centralized exchanges, that the retail finally came back to the market and started trading heavily, which pumped the market up. So you can see in the beginning of the launch of the Bitcoin ETF, spot ETF, not necessarily much happened because we were seeing a lot of outflows from the Great Sale Fund, and they were basically shifting over to cheaper ETFs. But then there was a massive expansion, and actually this was the most successful launch, ETF launch in history. Right now we're seeing a little bit of a cool down, which reflected on the prices of BTC. So we're seeing the market cool down a little bit. And finally, on the tokenization side, mostly being leveraged through stablecoins and tethered USDTs by far the most famous one here. So we see a lot of network effects, accounting for this. It's not necessarily all of institutional exposure, because obviously, and especially in Tether's case, there's a lot of retail using these assets to perform payments and remittances and whatever. But it's been the single most successful use case for RWA so far. And then you have smaller categories such as private credit and money markets and all sorts of TradFi financial assets, just as insurance policies and real estate funds and whatever came out into the market. I think institutions are realizing that one thing is to tokenize, right, and to get those assets on chain. The other thing is to find buyers for those. So we're seeing a lot of challenges, finding the liquidity for these products, and we can see here by the low TVL volumes. So when we take this into perspective, obviously, taking into account the total addressable markets, we're still scratching the surface, right? So there's still a long way to go. And in my opinion, my personal opinion, it'll be impossible to address the total addressable markets if not with the help of institutional, right? Currently, like 80% of the entire wealth managed in the world is being managed and concentrated on the institutional side. So we have to find a way to onboard these guys in. There's no other way. We need to bring volatility levels down, and the only way to do this is to increase the levels of liquidity. So, sorry. But how, what has been the DeFi adoption so far, right? One thing is to invest in those digital assets, but are they being deployed in DeFi protocols? So let's look at how these investments have flowed into the market, and starting by the venture capital. Obviously, the advent of custodians was a massive step in terms of regulatory approval. These guys are now deploying funds and buying funds directly on centralized exchanges and getting exposure to those assets through centralized exchanges. The liquidity funds have a mix of exposure, meaning that most of them are actually arbing the DeFi pools out, and that's the reason why we've been seeing a lot of correlation between DeFi TVL and centralized exchanges TVL. It's because the single most use case for these guys is actually to extract value out of the market through the inefficiencies of both pools. So they're both connected through custodians on centralized exchanges, but they're also connected to multi-sig smart contracts as safe to be able to access those DeFi markets. And then direct exposure, obviously, is through custodians, which, by the way, use CeFi to acquire the market. And tokenization is basically, issuing the asset, not necessarily deploying the asset on DeFi protocols. So out of all of these flows, very little goes to DeFi. And that's the reason why we've seen almost a perfect correlation between CeFi and DeFi TVL, right? So we haven't netted, we haven't made any remarkable improvements in terms of market share. We're just following through, right? So how do we onboard these guys into DeFi? First and foremost, let's just recognize that DeFi is complex, right? So the very single properties that make it so amazing, transparency, composability, permissionless, markets, democratization of access to those financial markets. They're all amazing, right? But they impose necessary trade-offs in terms of UX and execution and whatever, right? So we know that we have to evolve, and especially, and this one is the single most important thing in my personal opinion, which is we have cultural clashes here, right? Because on the one hand, it feels like DeFi was built for retail, right? And retail likes risk exposure, right? Because everybody wants to change, everybody wants to get rich, right? Everybody wants to trade the next meme coin, right? But that's not necessarily how institutions think, right? They're rational economic agents, right? So we got to address that kind of mentality. So how do you do this? First and foremost, we teach them, right? We educate them. We use this knowledge to address their value propositions, and then we don't go against regulation, right? We play with regulation. We shift regulation towards starting accepting DeFi. And then we show them yield, right? If there's anything that DeFi does well, is not only providing exposure to the assets, but also adding productivity to the assets by having those deployed in those DeFi markets. And then, because it's complex, we let somebody that really understands the market take care of it, right? And then we use the very same execution infrastructure that it's been taken care of for the longest, right? Because of the effects. So what will be karpatkey's contribution? So we've been managing all of those, big DAO treasuries out there using, a proven model that's comprised of pods that interact directly with each DAO's treasury, and they manage separately the portfolios, right? So what we're going to do is to create a separate pod that is going to take care of the institutional side, right? And we're leveraging the exact same execution infrastructure, right? So right now, each DAO has their funds, deployed on a safe. It's a one out of one, so we don't have direct access. We have granular access through the Zodiac rules modifier, which means that we can execute specific patterns, pre-approved patterns of transactions, and we cannot remove the funds over there, right? So it's pretty non-custodial. We plan to reuse the same infrastructure, but this time adding a layer that is pretty much an ERC 4626 like smart contract, which provides a share of the fund itself. So, and we're building a wrapper on top of that to allow us to manage all of that portfolio allocation through a fully regulated and open-end fund for private placement. So the first fund will be a DeFi Alliance fund. It's going to be a collection of the, native tokens for the leading DeFi protocols on each vertical. And we're not only offering exposure to those tokens, but also we're deploying those tokens in battle-tested DeFi strategies in DeFi protocols, hence extracting an additional 4 to 8% APR on top of that. And because we're leveraging existing infrastructure, it will allow us to run at a fraction of a cost. So in a sense, it'll be much more cheaper for those institutions to be able to get exposure to these DeFi blue chip tokens. And just to close the presentation up and open up for Q&A, we feel like we're really closing the circle because we're really the single entity out there that can source these low liquidity assets and do it at scale. And then we can turn capital back to the DeFi ecosystem, allowing for them to be able to reinvest in the ecosystem and create a more resilient infrastructure to be able to onboard the next $1 billion for the institutional side. So thank you very much. Any questions?
Okay, if there is a question, please raise your hand. No questions. Oh, there is one.
Mic's not working.
Hello. Can you hear me?
Yeah.
Yeah, perfect. So I'm part of a liquidity provisioning platform called A51 I wanted to kind of understand how you would work within the DeFi ecosystem with players like us who are building tooling, right, to essentially do active and passive liquidity provisioning. So how would you guys work with someone like us, you being a smaller player?
I mean, as I've explained before, we already have our own execution infrastructure. So we have a set of our trading desk already exists. It's already deploying the strategy on behalf of the DAOs. So that there's not many things that are going to change, besides having those smart contracts on top of that to provide sort of granular exposure to the portfolio allocation. So, I mean, the infrastructure is pretty much out there, right? It's been working for the last 3 years or so, and it's proven successful. So, we're not, for now, willing to touch on that just because it's working, right?